Hi everyone, welcome to another week of Nucleus Investment Insights. This week we're going to have a look at the housing rent heatwave. So we've obviously seen a lot of changes in terms of rents up significantly, and I just wanted to sort of touch back and have a look at how that's affecting some of these affordability stats, because as I think a lot of people will know who listen in regularly, we look at very much housing as being a choice between the different options in terms of saying, if interest rates are up, but rents are up as well, that sort of, everyone's got to live somewhere. And so the trade-off between buying versus renting, where does that sit? And so with housing rents sort of out of control, I thought it was well worth sort of touching in on some of these affordability stats and just looking at the investment prospects in terms of housing and where they sit in different cities. Just a reminder as well, everything you hear today is not investment advice, so it's all general advice. Sorry, it's not personal investment advice. It's all general advice in nature. If you are looking for personal advice, feel free to book in a call with us. But everything you hear today is just general in nature and sort of not specific to you. So I think one of the things I wanted to focus in on, we've got a house price calculator that is on our website, and a lot of this stats come from that house price calculator where you can see the different you can see the different statistics, how it flows in, and you can sort of run these calculations on up-to-date data as to how they're going to how these will show up. So I'll start with this is the idea first about the rents, and just coming back to some of the thoughts in terms of that, titled Rents Off the Leash, and this is some data from Core Logic, just sort of showing that in terms of housing rents, the bulk of the cities are all still running at sort of 9-10% rates. The units are sort of at similar levels, but have actually come back a fair bit from recent highs. So that the housing rates seem to be picking up again, whereas units still seem to be falling off, but both still growing really strongly in terms of the rates there. And Perth sort of sitting at that top end of the spectrum in terms of sort of growing at sort of 15% in terms of its rental rates. When you dig into that and say, well, where's the respite coming? And it doesn't look like there is any. Vacancy rates are pretty close to 20-year lows in most cities, or at 20-year lows. Then you go through and you look sort of at some of the median advertised rents, and again that's sort of no respite there. It's sort of going vertical, that line at the moment, and then. The main one, though, and I think anyone who's listened into some of our prior podcasts will be quite clear on this one, is that we've got this population change going on that's and looking at that versus dwelling completions, and you just headed in opposite directions. So we're sort of running record immigration rates, and even if we pull back to sort of some of the levels that are mooted in terms of quietening down, the population side is still running at rates that are much higher than what we have in recent decades. And so the level of housing completions we've got going on is sort of built for a population growth of sort of probably 200,000 or below, and we're running at much higher levels than that, and not no expectations of going the other way. And the irony is behind this is that we've got interest rates relatively high, trying to rein in this inflation, and there's no real that's preventing more housing being built. So higher interest rates is making it harder for the property builders to get in there and actually start building, and they're still going through that problems with inflation within prices. Building materials prices. So having said that, the other thing I wanted to come back to is this idea about what is an interest rate. So we've spoken about interest rates rising for in recent years, but realistically, there's a few different ways you can look at interest rates, and one of the ways in which we run the analysis on which I'm going to start digging into soon on the mortgage rates versus versus rents, and rents versus the rents versus your alternatives. And one of the key inputs obviously is the interest rate. The discounted standard variable rate is sort of traditionally what most people would think about. That's the one that gets reported, and that's the one we focus on what the RBA is doing with its rates. And that's this red line. I've got this red line on a graph here for anyone sort of listening in on the podcast and can't see it, and it's sort of showing that the discounted standard variable rates for sort of 4.5% for most of the early sort of 20 teens. Falling back to sort of 3.5%, and then now it's had this big rise, and it's up. If you're using the discounted standard variable, you're at sort of 6.7. If you're using the raw rate, you're well over 8 in terms of the rates. But we're figuring we're using the discounted one with a view that that's what the broad proportion of people who are showing up to get a new mortgage, that's what they're facing. The thing is though, you've also got the 3-year fixed interest rate, and that's the grey line on this chart. And that for most of that time was much lower than the standard discounted rate. And then it really plummeted down to sort of almost just above 2% when we went through the pandemic. And the idea here, I guess what I'm trying to say is that if you were showing up for a mortgage during the pandemic and you had the choice between taking a standard variable rate of sort of 3.7 or something like that, or taking a 2% mortgage out on a 3-year fixed rate, obviously the 2-year looks pretty attractive. And so we're sort of running this model where we're saying, and the other factor is this is a 3-year fixed rate for owner occupied. It does change for investors and all that type of stuff. So again, even more complicated in terms of what categories you're looking at. But there's generally a discount for people. We've got this discounted standard variable rate. There's usually a discount in terms of the fixed rates that people can achieve as well. And so we've sort of made some estimates on those, and I've got this blue line on the chart which is showing what's the minimum of the two. So if you took the view that people are, a large proportion of people who are turning up to get a new mortgage, whether that's going into a new, changing houses into a new mortgage, or buying a house for the first time, or buying a house for rent for investment purposes, is that if they're just going to choose the lowest between the discounted standard variable rate and the lowest and the 3-year rate, then that's the blue line that's on this chart. And from people sort of listening in, the big factor that you can see with this is that blue line's been falling for the last maybe 6 or 9 months. So the 3-year rates have been coming down, and so the standard variable rates have been going in exactly the opposite direction. But that sort of helps to, I think if you look at it on this basis, it actually helps to sort of understand some of the why we've seen house prices sort of starting to race ahead again. So while you had rising interest rates, the brakes were on, but actually, on this basis they stopped rising, in mid 2022. And for the last 2 years almost, you've basically had interest rates for new people turning up either being roughly the same as what they were, or lower than what they were the month before, which has sort of been that idea that you've had this pressure on house prices. So that's that part. Then you jump to the and so then I go, okay, what does this mean for affordability? So we look at a number of different ways. I'm going to look at it from on an investment perspective a little bit later, but the first way in which we're looking at it is the idea that what people can afford going forward is based on their wages. So if we're seeing lots of wage growth, then people can afford higher mortgages. That's the first part. Second part then is a push between the mortgage payment that you're paying and rent. So the idea is, well, look, if it might be true that, say, it's unaffordable on a wage basis, but if I don't have any choice, if my only choice is between buying something and paying whatever it is, $3,000 a month in interest payments, or renting something for $2,000 a month, then that there's a certain attractiveness in that. But if those numbers change and all of a sudden it's now $2,500 to buy to pay a mortgage and $2,500 to rent as well. Okay, now those numbers are equal, and people are more likely to want to buy rather than rent. So on this basis, and the final one's the property price to the median wage. Now that one's a bit harder insofar as it really only affects the sort of the initial purchase. So yes, you need to be able to save enough money to get a deposit, but there's also other ways, and there's inheritances and and gifts and bank mum and dad and all these types of things like that that can get people across the line for that initial payment. It's really then about we think the top two are more important about the ongoing. Can people actually afford to keep paying that rent? So the property price to median wage does make a little bit of a difference, but the top two we think are the most important. And so on that basis, and I'm going to run through most of the major cities here just to sort of show there's some quite stark differences how you look at it. So on a mortgage payment to median wage, yeah, we're running at 100% on that. You've never been higher in Sydney, never been less affordable. So it's over 100% is your median mortgage payment versus your median wage. And that, part of that's rents. Wages wage growth really hasn't been that strong. So sort of had some 4% numbers recently, but it's real wage growth has been deeply negative for a lot of this time, for a lot of the last few years. Mortgage payments versus rents, you're getting a little bit of respite on that, but you're still at the upper limits of where you've been. So within Sydney houses, you're basically looking at paying 3 times more to own a place than what it is to rent a place, even with the sort of dramatic rental growth we've seen in terms of that. So and sorry, when I'm talking about the mortgage cost, I'm talking about the mortgage cost on an 80% mortgage in this, and so that's sort of normalized over time. So you can sort of see going back in time that say the mortgage payment to median wages over the longer period was in Sydney sort of was traditionally around about the 50% levels, about the average. Back in the 87 housing price and crash, when we saw interest rates sort of at 20%, that sort of mortgage payment versus median wage hit around 80%, and now we're well over 100 at this point. And then similarly for the mortgage payment to rent, a couple of times it's been up around that sort of 170, 180 levels. Back in the 87, it was there. In the mid 2000s, it was there again. But that's probably more like 140%. And I guess my sort of take on Sydney houses is, look, when it gets close to 100%, so basically when the cost of a mortgage approaches the cost of a rent, then that sort of seems to be the bottom, and it's sort of 200% where it's sort of double the level. Then you're that sort of seems to be where it's capped out in the past. And then the property price to median wages is who knows how high that figure can go, but it's had a little bit of respite, so it's not at extreme levels, but it's up there. So then you start jumping through some of the other cities. Melbourne's a similar story, but the levels are much lower. So for the mortgage payment versus median wage, so you are still only looking at about 70% there. So it's sort of where Sydney's sort of over 100%. Again, it's all-time highs, but it's basically the same level you saw as in 87. So not as extreme. On a mortgage payment to rent basis, again, you're at the sort of that double level for the cost of a mortgage versus cost of rent. And then the property price to median wage, it actually doesn't look as bad. It's sort of it's bad, but it's at that sort of 91st percentile. So sort of in the top 10% of ranges where it's been, as opposed to being as extreme. You jump to Brisbane, and they actually, I think the interesting thing for Brisbane was over the last sort of 2 years, they sort of jumped from being relatively cheap actually on a number of these measures to as expensive as it's ever been. And so, similar figures for Brisbane. Perth, there's certainly some affordability that looks all right in that, and partly that's say on the rental side, partly that's that extreme rental growth we saw, that sort of 15% rental growth. So that if you look at the mortgage payments to rent, it's actually not that far off its average, because you've had such extreme, two factors. One is you had price falls in Perth during the early 2010s. Whereas while most other cities were going up, so that sort of helped your affordability. But then secondly, that extreme rent growth, and so it's sort of, Perth looks not that bad on a number of these measures, or certainly better than most other cities. And then finally, Adelaide, very much at the 100th percentile for everything on that. So that's those ones. I might jump just into a quick message, and then we'll come back and talk about units and what we're seeing within the rentals there.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
So you're coming back to the unit side. Now this is where it looks a lot cheaper. So I mean, it's not cheap by any means, but certainly your mortgage payment versus rent is at the 90th percentile. So and if you sort of look through that chart, 150%, it's been there lots of other times in the past. I guess in terms of mortgage payment to rents. Your mortgage payment versus median wage at 50%, it's above average, but it's not that much above average. It's sort of, it's often in the sort of high 40s, I guess, in terms of that. So it doesn't look terrible on Sydney. Similar story in Melbourne. You're now back to more like the your 66th percentile and your 80th percentile for how expensive it is. So on a unit affordability basis, it's sort of not far off its averages. And then and I've sort of, if you look through the other cities, you sort of end up with sort of similar levels. I think units are not as big of a part of some of those other cities, so sometimes the numbers can be a bit misleading, I think. But you're in that sort of 60 to 80th percentile for most of those in terms of affordability. So what does that mean? In terms of can we see more rental growth? Yeah, sure. It's not going to the affordability stats on that unit markets is not going to be not going to look as bad. And partly as well, that's the changes we saw during the pandemic, where the demand for houses shot up relative to the demand for units, and so we saw a lot more price growth in terms of the housing side rather than the apartment side. Now, when you look at investment returns, there's a couple of different ways you can look at it. One is just your gross yield. Now they're bad. They've been bad for years. There's no sort of I guess there's not a lot you can say on this one, but say in Sydney houses, if you looked over a sort of 50-year period, the gross yields you could get was up until 2000, you could get somewhere between 6 and 10% in terms of a gross yield. So that's basically how much you're paying in, how much you're receiving in rent versus how much you are versus the purchase price of the property. If you compare that to the mortgage rate, and I've done a net yield here as well. So net yield takes off the typical types of costs that you would see. Now, and these charts are relatively similar across most other cities. I'm just going to focus on the Sydney one. So the net yield, at least during the pandemic, say, for example, there was an argument to say, well, even though absolute yields were really low, your net yield versus the mortgage rate was actually pretty good. was actually better than it's basically ever been. You can get the same net yield on a property as what you're paying in interest rates, given you're paying 2%. So you get a 2% yield, and you get a 2 and the mortgage rates were 2%. But the issue now is that sort of turned relatively deeply negative. It's still not terrible, but it's it's obviously much lower than than it's been before in the past. So on the investment side, there's certainly not a lot that sort of comes to save you on that perspective. I guess the flip side is, if we do start seeing rate cuts come through, and at the same time we don't see a slowing in terms of the rental growth that we've seen, then that ratio will obviously start looking a lot better pretty quickly. If you look at the unit side, that looks much better again on that front. So your net yield versus an interest rate is roughly average. So 47th percentile. It's roughly where it's been over the longer term. So on that basis, if you keep seeing rental growth and get any sort of respite on that mortgage rate, then that sort of looks relatively attractive from that as a where it's traded in the past. Okay, so what does that? And then, so that's where we're sort of seeing in terms of the house prices. So extremes through most of it. There's some parts that are a bit cheaper. Units are more normal. So while it might feel like everything's really expensive, they if you're looking at relative to their longer term averages, they're sort of more above average rather than being extreme that you're seeing within the houses. So, and it's worth giving some historical context as well to these. So again, I'm just sort of looking 50-year charts, back at mortgage rates, and at 6.6 or 6.7, wherever that sort of pick what level you want to use at the moment. That is, it's actually sort of cheapish in terms of mortgage cost over the longer term, mainly because we had such higher interest rates back in the 80s and 90s. Inflation, it's come back down. It's sort of getting closer to its level. Probably the bigger issue is the house price inflation that we spoke about earlier. The ABS stats you see on that are quite different. And the idea is that, if you're getting, part of the real issue within this is that if you're not seeing the wage growth, and we really haven't been seeing the wage growth, then you're running into this problem that we've got this extreme amount of population coming in, which is keeping wages low because you're flooding the market with more people, and then on the flip side, you've got all this extra demand and not being met by housing, so you've got that housing inflation on that. And I guess where I'm sort of headed to with this is we really seem to be painting ourselves in Australia, painting ourselves into a corner in terms of the in terms of this. So it means the RBA is sort of on a bound or bound to keep interest rates higher because of these, because they've got that house price inflation keeps coming through. But on the flip side, we're just not seeing that rental growth, and it does sort of mean that the potential for accidents is much greater than I think what we've than what you see ordinarily. It is worth noting as well, mortgage rates. If we start looking at some of those valuation metrics, so this is just all those different metrics I had. The affordability statistics are the first sort of set, and then the investment return statistics are on the right, and then as you go down, we're looking at houses and units, and just looking at where's the current value versus where it's been over the last 50 years in terms of 100 is expensive and 1% is cheap, and there's very little that you'd describe as cheap in terms of that graph. Perth units actually look not too bad on the basis, they're about average, but and Brisbane units are probably a little bit only very slightly above average on most of these, but everywhere else, and particularly in the housing market, just at the extremes for these measures. So that's where we are in terms of the current spots. If you're looking at the changes, it's all getting worse as well. So over the last 3 months, it's none of that's sort of improving. So despite the fact you've had those some the increases in terms of the rents to help sort of some of the relativities, it still hasn't sort of improved those enough to make a significant difference. And so then you sort of need to come back and say, well, what does this mean for the Australian economy more generally? And I think there's certainly a case that to be made that you can push a lot of the poor, when you've got bad economic policy, you can stick with it for a long time, I guess, and particularly in circumstances where we've basically been running this same sort of same policy for the last sort of 15 odd years, which is pump through lots of people and use that to grow your GDP, and then talk about what a great economy you have, even though GDP per person or per capita, it might be going sideways or backwards. And certainly there's a lot of different national income statistics that are sort of going that on a per capita basis are going backwards. Australia, if you look over the last that sort of 15-year period, you can look at the growth rate, the GDP growth rate versus all our competitors and all the other sort of developed countries, and Australia ends up right up near the top on a GDP basis. But then you flip it into a per capita, and all of a sudden we go right to the bottom. And so it's this question about saying, okay, well, there's a business model of pump people through, and that certainly benefits some particular companies, and the types of companies that benefits are your a lot of your housing type developers. It benefits your oligopolies in terms of your Coles and Woolies and Transurbans and people that have got these fixed assets in attractive positions, and it's harder for competitors to come in and compete with them. And they're the types of companies, so the type of companies we've really seen benefit over the last 15 years are the ones that, if we get a change, will be the ones to lose, you'd expect from this the most. And so, are we seeing signs of a change at the moment? No, we're not. And so it really is just sort of a matter of it's grinding down that same path into, following those companies where you can see that they're going to benefit from the extension of this business model. But the question is keeping a close eye on this, because we're starting to reach the stage where it is starting to cause significant pain, and I guess you need you will need one of the major policies, one of the major parties, or a new party that pops up and gets popular support to actually start getting out and pushing some of these ideas and change of economic model. Australia does tend to be pretty good at managing crises, but the question for us now is, in terms of an investment perspective, is saying, okay, look, we need to keep in mind that these trends are in place. They look like they can still keep going further. Yes, it would be beneficial for lots of people if they changed, but that change doesn't look like it's imminent. And unless it gets forced upon us through either commercial property crisis, further China keeping trying to keep keeps slowing in terms of its growth rate and its demand for commodities tips off. Those are the types of things that could see Australia generate one of those, the moment where it decides to make decides that it needs to make a change. But for us, the investment side is actually more about saying, well, given Australia is starting to push the end of its life and the end of this economic model, it's time to start shifting as much of the assets as we can offshore. And so, we've been very much moving more into US dollar assets, looking at growth rates elsewhere where they're not running into they're not trying to run this same business model that's reaching the end of its life. Anyway, that's all we've got for today. Thanks for everyone for tuning in. If you want to grab any of our research, you can get us on all the different social medias, nucleuswealth.com. We're about to do a revamp of our weekly email, so I'm going to start pumping a little bit more of the content that we're producing out on that. And tune 12:30 on Thursdays if you've got any live questions you want to ask. Otherwise, I will see everyone next week.